Let's explore candlestick charts. You've learned how to read line and bar charts. Now, let's move to the most popular chart type, candlestick charts. By the end of this section, you'll know how to read candlesticks, interpret price action, and apply this skill to trading decisions. Let's go! We will start by breaking down the structure of a candlestick. Just like bars, every candlestick consists of 4 key components: opening price, closing price, highest price, lowest price. These components are displayed in 2 main parts. The body is the thick, rectangular part of the candle, representing the range between the opening and closing prices. Candlestick charts use colors, green or red, to instantly show if the price increased or decreased during the period. If the close is higher than the open, the body is usually green. If the close is lower than the open, the body is red. In other words, a green candlestick signals a bullish pattern, which indicates strong demand and buying pressure. A red candlestick shows a bearish pattern, signaling selling pressure and weaker demand. Let's check if you understood correctly. If the closing price is higher than the opening price, the candlestick will be red.
Yes, you're right.
When the closing price is higher than the opening price, the candlestick is green, showing the price increased. The wicks, also called shadows, are the thin lines extending above and below the candlestick body. The upper wick shows the highest price reached during the time period. The lower wick shows the lowest price reached. Together, the wicks reveal how much the price moved beyond the opening and closing levels. To make this clear, let's look at an example. In the candlestick below, you can see that the shares opened at $10, as marked by number 1 at the start of the hour, and closed at $20, as shown by number 2 by the end of the hour. This indicates a strong upward movement during that period. During the same period, the price also reached its highest point, as shown by number 3, reflecting the maximum level the market achieved. It also reached its lowest point, marked by number 4, showing how far the price dropped before the candle closed. Let's put that knowledge to the test. The closing price is $15 and the opening price is $10. Given that relationship, what color should the candlestick be? Green or red?
Yes, you're right.
You are right. This candle should be green. The closing price, $15, is higher than the opening price, $10, which indicates an upward price movement during this period. Green candles always show a closing price higher than the opening price. Just like a green candlestick, a red candlestick shows the open, close, high, and low, marked by numbers 1 through 4. The difference is that the close is below the open, meaning the price dropped. In the candlestick shown below, the price opened at $20 at the start of the hour and closed at $10 by the end of the hour, indicating a downward move. Each candlestick tells the story of price movement within a specific time period. A candlestick's color shows price direction: green for upward movement, red for downward movement. This reflects market sentiment, bullish or bearish. Meanwhile, you can check the volatility by looking at the wicks. Long wicks indicate large price swings, high volatility, while short wicks show stable movement, low volatility. Candlesticks display the same information as bar charts, but highlight direction and volatility more clearly, making it easier for traders to read market trends at a glance. Let's practice reading what a candlestick tells us about market activity. Based on this candlestick, which statement best describes what happened in the market during this period? Was there consistent selling pressure throughout the period? Was the market stable with little price movement? Did the price open and close at the same level? Or did the market experience strong buying pressure overall, despite some volatility?
Yes, you're right.
Correct. This green candlestick shows strong buying pressure with some volatility. It opened at $50 and closed at $60, showing an upward move. The high reached $65 and the low dropped to $48, so there was some volatility. But buyers prevailed, with the price closing $10 higher. A candlestick's color shows price direction: green for upward movement, red for downward movement. This reflects market sentiment, bullish or bearish. At the same time, you can assess the volatility by looking at the wicks. Long wicks indicate large price swings, high volatility, while short wicks show stable movement, low volatility. But candlesticks don't stand alone. They connect and form a continuous story. Each candle's opening price often matches the closing price of the one before, creating a smooth, linked sequence of price movement. In other words, to identify the candle color, you have to compare the opening and closing prices. If the close is higher than the open, the candle is green. Buyers push the price up. If the close is lower than the open, the candle is red. Sellers drove the price down. Let's try to connect the candles to tell a broader story of price movement. Take a look at the relationship between the opening and closing prices for each candle. What is the correct sequence of colors for all 4 candlesticks, from left to right?
Yes, you're right.
Well done. The answer is green, red, green, red. Remember, green means the closing price was higher than the opening price, while red means it was lower. As I've mentioned, candlesticks connect to tell the story of price movement. But how that story unfolds depends on the time frame you choose to view it. Popular time frames include 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, and monthly charts. You should focus on common time frames because that's where most traders are watching. When many participants react to signals on popular charts like the 1 hour or daily, patterns become more reliable and trends stronger due to shared behavior. Great job! You've mastered how to read candlestick charts and interpret price action. Next, we'll take things further. After a short quiz, we'll explore chart patterns, key techniques traders use to predict market moves and trade smarter. Let's explore new patterns. Understanding patterns isn't just theory, it's a skill that shapes your trading strategy. You're now ready to recognize patterns like hammer and shooting star, which can guide your decisions in real time. Let's dive in. Let's start with a hammer pattern. It is a bullish reversal candlestick pattern that appears after a downtrend. This pattern suggests that, despite selling pressure driving prices down, buyers stepped in to push prices back up, closing near the opening price. How can you recognize hammer? It looks like a hammer with a handle and a small head. The candle has a small body and is located near the top of the trading range. This shows that although prices moved lower during the session, they recovered and closed near where they opened. You can also see that the lower wick is at least twice the length of the body, showing that sellers drove the price significantly lower, but buyers pushed it back up before the close. Hammer candlestick usually has little to no upper wick. This means there was minimal upward movement beyond the opening price. Picture this. The market is in a strong downtrend. Sellers have been in control, driving prices down, but then a hammer candlestick forms, signaling a possible change. The price dropped as low as $45, but bounced back to close near $50. This suggests that buyers stepped in aggressively, absorbing selling pressure. What does it mean for traders? This could mean the downtrend is weakening and the price might start going up soon. Many traders will wait for the next candle to close higher before deciding to buy. This confirmation helps reduce risk. Once confirmed, it's your chance to enter a trade and ride the potential uptrend. Based on the hammer candlestick we just analyzed, what does this signal about market sentiment? What does this candlestick pattern typically suggest? Is it a strong sell signal, meaning prices are likely to fall? Does it show the market is in perfect balance with no clear direction? Does it not provide any useful information, or could it be a good time to buy, expecting prices to go up?
Yes, you're right.
Great observation! This candlestick suggests it could be a good time to buy, expecting prices to go up. The long bottom wick shows initial selling pressure, but the close near the high indicates strong buying pressure took over by the end of the session. We've just seen how the hammer can signal the end of a downtrend and the start of a potential uptrend. Now, let's flip the script. There's a pattern that tells us the opposite, that an uptrend might be losing strength. It's called the shooting star. A shooting star forms after an uptrend and shows us that while buyers tried to push the price higher, sellers stepped in and forced the price back down before the session closed. It's like a warning light flashing. The market's upward momentum might be fading, and a reversal could be on the horizon. Visually, the shooting star mirrors the hammer, but in reverse. It has a small real body positioned at the lower end of the trading range and a long upper shadow, reflecting a failed attempt by buyers to sustain higher prices. There's usually no lower wick, making the signal even stronger. Imagine a stock that has been rising steadily over several days, moving from $80 to $95 on the day the shooting star forms. What happened? The price opened at $94 and surged up to $100 as buyers pushed higher but couldn't hold. Sellers stepped in, driving the price back down to close near $95 just above the open. When you spot a shooting star at the top of an uptrend, it suggests that buying pressure might be weakening. But experienced traders don't react right away. They wait for confirmation, usually in the form of a red candle closing lower the next day. This confirmation shows that sellers are taking control. Once the signal is confirmed, traders often respond by closing their long positions to lock in profits or by entering a sell trade to take advantage of the potential reversal. Quiz question: you spotted a candlestick with a long upper wick and a small body near the bottom, right after a price surge. It looks like a shooting star. What does this candlestick pattern typically suggest? Is it a strong buy signal, with prices likely to rise? Does this pattern not give any useful information? Could it be a good time to sell, expecting prices to fall? Or does it mean the market is stable with no clear trend?
Yes, you're right.
Well done! This candlestick suggests it could be a good time to sell, expecting prices to fall. The long upper wick shows buyers lost control, and the close near the session's low indicates sellers are gaining strength. Great work! You now know how to spot both hammer and shooting star patterns, and more importantly, make smart trading decisions when you see them. You've added 2 powerful tools to your trading toolkit. Ready to take it further? Let's continue and explore even more candlestick patterns that can sharpen your strategy. Let's explore patterns. You've learned how single candlesticks tell a story. Now, let's take it further. In this section, we'll explore engulfing patterns, where 2 candles together reveal powerful signals of potential trend reversals. Let's learn how to recognize them, confirm the setup, and confidently decide whether to buy or sell. A bullish engulfing pattern is a powerful reversal signal that often appears at the end of a downtrend, indicating a potential shift from bearish to bullish sentiment. You are looking at bullish engulfing if you see a small red bearish candlestick that is followed by a larger green bullish candlestick that completely engulfs the body of the first candle. This pattern typically forms over 2 consecutive time periods, whether you're viewing a daily chart, hourly chart, or any other time frame. What matters is that the second candle fully covers the first, signaling a potential shift in momentum. Here's what's happening. Sellers initially control the market, pressing prices lower. Then, strong buying momentum steps in, reversing the move and lifting the price above the prior session's open. This decisive shift hints at a possible bullish reversal. Let's visualize it. The stock's price has been sliding. On day 1, it opens at $50 and closes at $48. Sellers are clearly in charge. But on day 2, it opens at $47, rallies, and closes strong at $51. This bullish candle engulfs the first one, a sign that buyers are now in control and the downtrend may be coming to an end. After spotting a bullish engulfing, traders typically wait for the next candle to close higher. This confirmation strengthens the signal. Once confirmed, they may enter a buy trade. Quick task. Make a trading decision. You spot a bullish engulfing pattern on the chart. Day 1 closed at $48 and day 2 closed at $51, fully engulfing day 1. Rearrange the steps in the correct order to make a smart trading decision. A bearish engulfing pattern is a strong reversal signal that typically appears at the end of an uptrend, indicating a potential shift from bullish to bearish sentiment. You are looking at a bearish engulfing pattern if you see a small green bullish candlestick, which is followed by a larger red candlestick that completely engulfs the body of the first candle, signaling strong selling interest. Here's how it plays out. Buyers are in control at first, steadily pushing prices higher. But then, sellers step in with force, driving the price back down and closing below the previous session's open. This strong shift signals a potential bearish reversal. Consider a stock in an uptrend with the following candlesticks. Day 1 opens at $100, closes at $102, bullish candle. Day 2 opens at $103, closes at $99, bearish candle engulfing the previous day's body. This pattern suggests that sellers have taken control, potentially reversing the prior uptrend. Just like with bullish engulfing, traders usually wait for confirmation before acting. If the next candle closes lower, it confirms sellers are in control. Once confirmed, many traders consider entering a short trade. You spot a bearish engulfing pattern after a strong uptrend. On day 1, the price opens at $100 and closes at $105. A small bullish candle. On day 2, it opens at $106 and closes at $99. A large bearish candle that engulfs day 1. What should you do next?
Yes, you're right.
Well done. Recognizing a bearish engulfing pattern is just the first step. Waiting for confirmation helps reduce false signals and improves your risk management. Not all bullish and bearish engulfing patterns are equally strong. Stronger signals usually have a larger second candle that fully engulfs the first, a clear, extended trend before the pattern, high trading volume during the engulfing candle. These details help you judge if the pattern is worth acting on, or if it's better to wait. You've mastered engulfing patterns and know how to recognize when buyers or sellers are taking control. Now, you're ready to apply this knowledge in real trading situations. Next, we'll explore another key pattern to sharpen your trading strategy even further. Reading market uncertainty. Doji patterns. Engulfing patterns show clear momentum shifts, but what if neither side is in control? That's where doji patterns come in. Let's break down 3 key types and how they can signal potential reversals. Let's start with the basics. What is a doji? A doji forms when the opening and closing prices are nearly identical, creating a candle with little or no body. This signals a balance between buyers and sellers during that session, showing market indecision. On a chart, a doji appears as a cross or plus sign due to its minimal body. This shape reflects the market's indecision, as prices moved higher and lower during the session, but closed at or near the opening price. While dojis can appear during any phase, they're most telling after a strong trend. Their presence hints at hesitation, maybe a reversal, maybe just a pause. Either way, it's a moment where smart traders take notice and prepare. A doji tells you the market is undecided. Your move? Stay patient. Watch what happens next. Look for a strong candle to confirm if the trend continues or reverses. And if you're in a trade, consider tightening that stop loss. You're analyzing a stock that has been in a strong uptrend for the past month. Today, you notice a doji pattern forming. From this chart, what's the most logical next step?
Yes, you're right.
Well done! Doji candles suggest uncertainty. Waiting for the next candle helps confirm the market's direction before making a move. Well done! Now you've seen how a doji signals market indecision and how smart traders stay patient, waiting for confirmation before acting. Recognizing moments of hesitation in the market is just as important as spotting clear trends. It keeps you one step ahead. Doji shows indecision, but sometimes that indecision leans toward one side. Let's look at the Gravestone Doji, where buyers lose control and sellers step in. The Gravestone Doji has a small or non-existent body at the lower end, with a long upper wick. Visually, it resembles an inverted T. This pattern is especially meaningful after an uptrend, hinting that buying pressure may be weakening. Like the standard doji, the Gravestone has the open and close prices at the same level, typically near the session's low, while the long upper shadow reflects failed attempts by buyers to maintain higher prices. This signals strong selling pressure overcoming buyers. Traders often see this as an early warning of a potential trend reversal, where sellers may start taking control. Confirmation is key with a Gravestone Doji. Traders wait for a lower close to confirm selling pressure, then may exit longs or enter shorts, placing a stop loss above the pattern's high. Now, meet the Dragonfly Doji, the mirror image of the Gravestone Doji, carrying a different message. It has a long lower wick and a small or no body at the top. This shows sellers drove prices down during the session, but buyers fought back, pushing the price back to the open by the close. This pattern often forms at the bottom of downtrends, hinting at a possible uptrend reversal. It signals that buyers are stepping in at lower levels. Like other doji variations, the Dragonfly's open and close are at the same level, near the high of the session. Its long lower wick shows rejected lower prices, a clear sign of buying strength. It's crucial to look for confirmation following a Dragonfly Doji, as it suggests a significant shift from selling to buying momentum that may lead to an upward trend. The Dragonfly Doji can signal that buying interest is strong and may outweigh selling pressure, leading to a potential uptrend. All doji patterns have no visible body.
Yes, you're right.
Doji patterns are characterized by having the opening and closing prices at or very close to the same level, creating a minimal or non-existent body. Let's practice spotting and understanding dojis in action. You're monitoring a stock that's been in a downtrend. You observe a Dragonfly Doji forming at a support level, followed by a strong bullish candle. What does this pattern suggest about market dynamics, and what might be a prudent trading strategy?
No, the correct answer was
It suggests a potential reversal. Consider a small long position with a stop loss below the doji's low. That's not the optimal interpretation. The Dragonfly Doji at a support level, followed by a strong bullish candle, is actually a potentially powerful reversal signal that shouldn't be ignored. The doji and its variations offer a snapshot into moments of market equilibrium where neither sellers nor buyers have clear control. Recognizing these patterns can help traders anticipate significant shifts in market sentiment, thus aiding in making more informed trading decisions. Great job! You can now confidently spot doji patterns and understand what they reveal about market sentiment. Before moving on, let's put your knowledge to the test with a quick quiz.